All right, hello everyone. Thanks so much for joining us today. We are Farmtogether, and we're going to be sharing more about how you can diversify your portfolio with investments in direct farmland. My name is David Chan. I'm the COO and co-founder of Farmtogether, and I'm joined today by my colleague Josiah Terrell-Perica, our Director of Farmland Investing. So we'll be going into three sections today, the first of which is why invest into American farmland. Farmland globally is an $8.4 trillion market with just a meager 1.5% institutional investor ownership. And so the vast majority of investors in this space, or owners in this space, are owner operators, meaning that not many investors have been able to deploy capital into this asset class. And why hasn't this happened yet? A couple of reasons. First, buying and managing farmland is complex. These are very private markets that often require relationships with growers in hyperlocal areas, and adequate management requires operational expertise. The ability to farm certain commodities is very specific and does not always translate to other commodities, and there are also regional factors that must be considered, such as microclimates and various local laws, such as water laws and environmental laws. And so this is a very complex asset class to manage on an operational level. This is also a very fragmented market. So 80% of harvested cropland in the US is found in farms that are between 150 to 5,000 acres in size. So the vast majority of US farms are on the smaller side of scaling. While 5,000 acres sounds large, and of course it is, compared to other countries that have much larger and less fragmented farmland markets, these are tiny in comparison. In Brazil, many farms have runways. In the US, this is not the case. And so our farmland market is much more fragmented. And finally, we expect a significant generational change in ownership, and we're already seeing this occur. Families, as we mentioned earlier, owner-operators and families own 97% of US farmland. The average age of a US farmer today is approaching 60 years old, and the next generation does not always want to go into the business. And so the USDA is projecting that at least half of all US farmland is slated to change hands over the next 20 years, meaning that we are going to see an unprecedented amount of supply become available in this otherwise very private and locked market. So why is this interesting? What are the key investment highlights that make farmland an exciting asset class? Well, first, it's very attractive on a risk-adjusted return basis. The risks in farmland can be mitigated and are relatively low, and the returns have been favorable and stable over the past several decades. Additionally, there's stability and certainty of the cash flows. This is a real asset, and so there are two different return streams. There's generally an income-generated return, which can be generated from operating income or from rental income if leasing to a tenant, and also a return from appreciation, or the appreciating value of the underlying asset over time. Farmland has also proven to be an uncorrelated asset class that has also shown to be resilient to inflation. And so in times of market turmoil, this has been a very resilient asset class that has performed well. And finally, we believe that there are long-term industry tailwinds, such as a growing global population, an increasing complex diet, that will support asset prices for time to come. Diving into some of these factors, we look at returns first here. From 1970 to 2015, the average annual return of US farmland was 10.5%. That data is compiled from an index called the NCREIF, which is a benchmark for institutionally managed farmland in the US. The low volatility of the returns should also be taken into consideration when thinking about this 10.5% average annual return. The volatility for the same period on an average annual basis was just 6.4%. Furthermore, this asset class has been uncorrelated with other asset classes. We'll dive deep into a comparison in just a bit on how farmland correlates with stocks, bonds, and even gold. But as you can see here, the average annual correlation has been anywhere from negatively correlated at -0.25 to just 0.3. making it a great diversifier for most portfolios. And finally, we believe that there are long-term tailwinds that are supporting this asset class. There's high demand with decreasing supply. Every day we lose over 100 acres of US farmland, it's projected, and over time we've lost, actually, I think since 2000, we've lost twice the size of the state of Massachusetts in US farmland, which is pretty incredible if you think about it. And so we have decreasing supply. As mentioned earlier, we have a growing global population with an increasingly complex diet, so we have increasing demand. And also, because of the nature of how market turmoil typically pans out with panic buying, there tends to be strong support on the consumption side, even in times of market trouble. And so because of that, this has proven to be a recession resilient asset class. Looking at some of the historical performance over time, we break up the asset class into two key and distinct subclasses. The first being annual row crop, and the second being permanent cropland. Annual row crops are crops that are planted every single year. They tend to be lower risk, and as a result, also lower return. And while these returns are more stable, they tend to be driven more from rental income as opposed to operating income, which we see more on the permanent side. Examples of annual row crops range from many grains such as corn, soy, wheat, also legumes, grasses, hay, alfalfa. And so they are typically found, these croplands are typically found in the Midwest, Mississippi Delta, and also into the Intermountain West and West Coast. Permanent cropland tends to be higher returns, but also higher risk because of the operating nature. You're investing into a long-lived asset, a tree, or maybe a vine, and you're going to depend on that tree or vine to produce cash flows for the next 20, 30, maybe 40, or even 50 years in some cases. And so the health and the vitality of the tree and vine are imperative to the overall outcome of the investment. As you can see below, over time, both row cropland and permanent cropland has produced positive income and appreciation for almost every year dating back to 1992. There have been a couple of years of negative appreciation on the permanent cropland side, but overall, there have been substantially more positive years than negative, and no negative years on the row cropland side. Three pillars that we believe make farmland the strong all-weather asset class that it is are the inflation hedge component of farmland, the uncorrelated nature of the asset class, and the dual return profile. So on the inflation side, farmland tends to track inflation very closely. Farmland products, so if you think of raw commodities, raw foodstuffs, they go into just about every product you can imagine, well beyond food that ends up on our plate. Sometimes raw materials go into consumer goods like pencils or clothing. And so because of the nature of how these raw commodities are used, it tracks inflation very, very closely. Furthermore, as we discussed earlier, this asset class tends to be very uncorrelated, with little correlation with other real assets such as timber and real estate, and actually negative correlation to some major asset classes like public fixed income. And so we'll see that in a bit. And then also having a dual return profile helps to de-risk the asset class. You're not only counting on an appreciation return, you can also depend on an income return, which also produces cash distributions throughout the investment horizon. Furthermore, we think that the opportunity today in US farmland is for farms that are too small for institutional players, yet too large for most other investors. We believe that having a technology-enabled sourcing strategy, such as the one that we have developed at Farmtogether, is a perfect solution for addressing these medium-sized farms. So as promised, taking a look into the cross-asset class comparison, here we see total returns across several asset classes from 1991 to 2019. And so farmland, you'll see there in the blue. We have stocks in green, and US bonds in red, gold yellow, and real estate is the brown. And as you can see, every other asset class shows more volatility than farmland. Every other asset class shows at least 1 year of negative total return, but farmland. We have several years of negative total return in stocks, which is not surprising. But yet, even in US bonds, we see a year of negative total return right before 2015. Real estate, although generally positive, also had a very tough period. Many of you are familiar with the Great Financial Crisis and the subprime mortgage crisis. And gold, although typically resilient, also shows many years of negative total return as well. Farmland, although not consistently the highest total return asset class, is consistently above 0%, making this a superior asset class for capital preservation. Furthermore, as we discussed the uncorrelated nature of this asset class, the asset class is negatively correlated to stocks, US stocks, negatively correlated to US bonds, virtually no correlation with gold, another real asset, and only a slight correlation with real estate. And so when you add farmland to your portfolio, you're going to enjoy diversification benefits from having this uncorrelated asset class now in the mix of your overall portfolio allocation. That brings us to our second section. Now that we've learned a little bit about why American farmland might be an interesting asset class, why invest through us here at Farmtogether? We are focused on, again, that opportunity in mid-sized farms. We like average farm prices to be between 1 and 10 million. We think that these are the farms that are often overlooked by larger institutional investors, but are out of reach of most smaller family-owned farms. And so this is an overlooked part of the market that deserves close attention. This comprises 375,000 farms in the US, or 60% of the cropland market, and it's a $1.1 trillion addressable market. And so this is a very, very, very large segment of the US farmland market. And this is also a part of the market today that is experiencing some of the highest rates of generational transfer. As farmers start to think about estate planning, it tends to fall in this pocket of $1 to $10 million farms where the farmers and owners are thinking about who are they going to transfer the farm ownership to. And sometimes we see complex scenarios play out where there are several heirs to the farm, maybe 3 children, and 2 children would like liquidity and would like to sell their interest in the farm, and maybe 1 child wants to continue owning a portion of the farm. And so what we can do is come in and syndicate the 2/3 of the equity value of that farm out for the 2 children who are looking for liquidity, while leaving a 1/3 minority residual stake with the original owner's child who wants to continue owning that piece of farmland. This makes us a unique capital source provider and partner for many farmers in America who are going through this problem today. And we are so excited to be able to help them. Furthermore, our competitive sourcing allows us to purchase off-market properties, unlock value creation through our proprietary playbook, strategically partner with leading investment and management companies with proven track records, target competitive markets and opportunity sets, and last but certainly not least, build a best-in-class management team. And so on that note, and speaking with someone who is, in my opinion, best in class, I'd like to introduce our permanent crop farmland lead and director of farmland investing, Josiah Terrell-Perica. Josiah, if you could just share a little bit about your background and what brought you to that'd be great.
Thank you, David. So hello, everybody. My name is Josiah Terrell-Perica. I've been in the farmland investing space for about 5 years. And at Farmtogether, my role involves sourcing, underwriting, and leading due diligence. In the 4 years prior to Farmtogether, I was at Peach Agricultural Investments, working on their acquisitions team. And there I deployed about $250 million of capital into permanent crops on the West Coast. And that included, let's say, $20 million of apples in Washington, $20 million of hazelnuts in Oregon, and the balance of that in California. So in addition to spearheading underwriting, commodity, and water research, I also worked on every side of the deal, every piece of due diligence, and really love farmland as an asset class, and really excited about the potential at Farmtogether and the value we bring by integrating technology and our depth of experience across dozens of different commodities on the West Coast.
Thanks, Josiah. And furthermore, just a couple of other partners and strategic advisors to Farmtogether. We're lucky to be surrounded with such a great team. Richie Prager, who's one of our investors and advisors, was the former global head of trading and liquidity strategies at BlackRock. Richie is an expert on both fintech and data asset builds, particularly around real estate. And so he's just been a tremendous partner for us. Alex Shevchenko is an investor and advisor as well. He's the co-founder of Grammarly. Max Lipton, another co-founder of Grammarly. Teo Spearings, who is a board observer, was a former CEO of Fonterra, the largest dairy exporter in the world. And then Nav and Fadi as well make up some more of our strategic advisors and partners. So we're very lucky to be surrounded with folks like these who have really built empires in both the entrepreneurial and finance communities and are helping us to unlock this very promising asset class. So the key levers that we believe allow us to achieve value are liquidity premium, being able to offer creative capital solutions, and being able to leverage AI or artificial intelligence and machine learning to help us in our sourcing. On the liquidity front, typically assets that are liquid are valued 20 to 30% higher than assets that are illiquid. And so our crowdfunded model allows us to build a large community of investors, which then allows us to support a secondaries market. So if you invest in a Farmtogether deal that, let's say, has an investment horizon of 7 years, of course, we would certainly recommend you only move forward with that investment if you are comfortable with that investment horizon. But life happens, and perhaps there's an emergency event in year 3 where you need access to cash and you would like to liquidate your position. What we do is we'll support a secondaries environment, and we will pair you to the best of our ability with another equity investor in that deal. And if not in that deal, then another equity investor on our Farmtogether platform to purchase your stake in that deal and provide you with the liquidity that you need for whatever event you may be facing. And so we are very excited to be bringing that to our investors. And our first secondaries market deal will open in September of this year, 2020, for our El Nido property, which you'll learn about in just a moment. Furthermore, as we alluded to earlier, our ability to offer creative capital solutions to farm owners during this time of estate planning and transfers makes us unique and competitive in many aspects, because we're not just coming in with a plain vanilla solution. We're trying to build a solution that meets the farmland owner's needs. And then lastly, we use technology to help us source and identify the very best properties that are available in the United States. So again, just bringing us back to the decision of annual row crops versus permanent crops. We talked about the risk profiles and the differences between annual crops that tend to be a bit lower risk, lower capital expenditures up front, shorter harvest periods, and the risk-adjusted returns reflect that lower risk. And so generally, we are underwriting annual cropland deals with net IRRs of anywhere from 7 to say 10% on the high side. For permanent crops, there are longer investment horizons. Examples of permanent crops include tree nuts like almonds and walnuts, and also vineyards, wine grapes, table grapes. These tend to be higher in total return. We'll see annual cash flow yields of anywhere from 7 to 8%, land appreciation values of 5%, and total net returns can exceed 10% and approach 15%, or even higher if there's a development component. And so certainly higher on a total return basis, but with that higher total return comes a bit of added risk. Our target areas in the United States for row crop investments tend to be in the Midwest, no surprise there, but we like the upper Midwest for a number of reasons, including climate and suitability. We believe that targeted areas of the Midwest have competitive yield growth rates that are higher than most other parts of the US. We also like to target certain properties in the Pacific Northwest, particularly Washington and Idaho, that are very attractive on a relative value basis. For our permanent crop strategies, our permanent cropland tend to be on the West Coast, so Washington's stretching down to California, and also Arizona. Most of our properties to date are in the state of California, and we're also working on deals in the state of Oregon. And we have many opportunities that we're excited about in both Washington and Arizona planned for later this year. A quick note on our El Nido deal. So that was our first property, our first investment. We were able to secure that deal at a purchase price or an acquisition price that was 20% below market comparables. And so this was a really excellent entry point. And that was really, I think I'll let Josiah speak to the deal a bit more, but it was a great way for us to demonstrate our ability to source very competitive deals in the very best areas for water and the very best areas for yield in the United States. And so with that, Josiah will tell you a little bit more about our past deals.
Okay, so El Nido, that was a deal we closed in the second half of 2019. This was an opportunity that was owned and operated by the Athwell family. Our advisor, Nav, he's the head of TriNut, which manages this property. And it was about a $500,000 deal, returns projected a little bit over 11%, 5-year hold. And so far, we've exceeded our underwriting expectations. We make it a point to be conservative on our assumptions and to make sure our assumptions are tethered to realistic market values. The next deal, the Arosi Mandarin deal. So prior to joining the Farmtogether team, I was actually working on a Mandarin deal that was about $20 million in the exact same area. And mandarins are the superstar of the citrus category, impressive growth in both just marketing and consumption. And really love the area for the water. It's an Orange Cove irrigation district. This is one of the few places in the Central Valley that has a stable aquifer and also very high per acre water allotments from the Friant division of the Central Valley project. So these trees are younger. We bought them when they're about 3-4 years old. And yeah, this is a very strong investment, high cash yield, 7-year hold. And yeah, in the next couple of months, we expect to make our first distribution to investors. So yeah, we acquired it in February 2020. And yeah, it's a very beautiful property right in the heart of the citrus belt. The next deal, Chester Almond and Citrus Farm. Both of these, the Mandarins and Chester Farm, are located in Tulare County. Chester is actually just a couple miles away. They're very close to each other, and both are operated by Greenleaf Farms. And I had a prior relationship with them prior to joining Farmtogether, and they farm thousands of acres in this area. They have a top-notch team. They farm for institutional investors, and they have a very good reputation in the industry. So this property here is more turnkey, a little bit more mature than the Arosi Mandarin property. It has about 2/3 almonds, 1/3 oranges. It's also located in Orange Cove irrigation district. Yeah, the water fundamentals are very strong, particularly with a crop like almonds, which require slightly more water than citrus. The fact that it has a stable aquifer and it's a very sophisticated district, very confident about the water prospect there. Plus the microclimate in this area allows one to grow multiple crops. So this is one of the few areas in California where you can grow both. Let's say you can grow nuts, you can grow tree fruit, you can grow citrus, and you can grow vines. So that really helps with the exit value and plays to our thesis on both the strong fundamentals and conservative underwriting, strong returns.
We are excited to learn more about you and your investment needs. And so we encourage you to reach out to us. You can email us at any time at info@farmtogether.com and schedule some time to chat and ask any questions you may have. To learn more about our company and our offerings, we encourage you to visit our website, www.farmtogether.com. There you can download our white paper to learn more about the asset class and see our current offerings where you may be able to become an investor in American farmland yourself. And so thank you again for your time and look forward to hearing from you soon. Take care.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.